Brian, it feels bad when you look at that data coming from November to November last year. Is it going to get worse if we look at the December to December data going back last year?
No. If you look at the credit market, it's actually pricing in less worrisome trends in bankruptcy. Credit spreads in the junk market, they're a fraction of what they were during other panics in the last decade, like 2011 when the U.S. lost its AAA rating and when oil prices collapsed in 15 and 16. So if you're looking at the broad market itself, I don't think bankruptcies are going to be a big issue. The big issue, I think, is going to be the transition towards lower inflation, which is what the bond market's predicting. And Carvana's problem was that pandemics create shortages and gluts. So when there was a shortage of cars, they had to pay a lot to get the inventory they had. And now that auto prices are coming down in the used sector, that's a problem for them.
So if you look at, people always talk about bankruptcy as sort of being like a forest fire. You know, it clears out the underbrush when you have one of these pullbacks, and that can be a healthy thing for the overall ecosystem. If you think of that happening again now, what sectors are you looking at for more bankruptcies? If you're thinking overall the trends are relatively good, we're still going to see some pain here someplace, right?
We are, because as I've said over the last couple of years on your show, pandemics create shortages and gluts. So when there's a shortage, people over-order their inventories, and you're seeing that at retailers right now. So I would avoid retailers that don't have a handle on their inventory, because that's going to put downward pressure on pricing. In the auto sector, as I just said, I think those prices are going to come down as well.
And how do you
they're
know?
already doing it.
As a regular everyday investor sitting in front of your laptop, how do you know whether a company has a handle on its inventory? What do you look at?
Well, you look at their balance sheet.
Yeah.
And on the balance sheet, they have the inventories there. And Carvana's inventories tripled over a year.
Right.
And so since the spring, Carvana's debt has been trading at distress levels. That is the clue. When your inventories are out of control and then the prices on those inventories are coming down, that's a real negative for the bottom line. And so I think a lot of retailers are going to be struggling with these. I think the car makers, I think are going to be in trouble next year. Not bad trouble, but they're going to have declining prices next year because they've overordered. Chips were in short supply. Now we have a glut of chips, which means that next spring and summer, we're probably going to have a glut of cars. And this is normal for a pandemic, with prices going up and down as these shortages and gluts work their way through the economy.
Brian, it's Kelly. It's great to see you again. And would you say that you're basically bearish on some specific parts where we could see gluts? Or even, I thought it was interesting, the oil market, if prices remain below 75. But would you say you're bearish on specific parts of the credit or stock markets, but more bullish overall? Or are the distresses we're seeing in these subsectors signs that a larger problem is brewing?
This is the most complex investment environment in most investors' lifetimes. And so there's a lot of moving parts. There's going to be a lot of volatility. I think over time, stock prices will go up, but certain sectors are going to get into trouble, like oil again. I was on your show 10 years ago when oil was well above 75. And I said, if that threshold gets broken, that's a negative for oil.
I remember.
Because people have to unwind their trades. And now we're doing it again. We're at the exact same spot. Only we've gone from below zero 2.5 years ago on oil futures to a record 135 and now back down to 75. That is not normal, but that's typical for a pandemic.